Yesterday afternoon at 2 p.m. Eastern Time, the Federal Reserve announced it was holding interest rates unchanged. By the close of markets, the Dow Jones Industrial Average had fallen 1,053 points, its worst single day since April 2025. The S&P 500 dropped 1,050% off its all-time high. But the most important number from yesterday was not in the stock market, it was in the bond market. The yield on the 30-year US Treasury bond closed at 5.2%, near its highest level in decades. The 10-year Treasury yield jumped 7 basis points to 4.67%. These moves did not happen because investors panicked, they happened because investors delivered a verdict. The verdict was this. The Federal Reserve, by choosing not to raise rates in the face of stalled disinflation, persistent inflation above 4%, and oil pushing toward $100 per barrel, is falling behind the inflation curve. And if the Fed will not tighten monetary conditions, the bond market will tighten them instead. This is not new behavior from bond markets. It has a name, it has a history. And that history is one of the most consequential and most consistently ignored patterns in the entire record of modern finance. The bond vigilantes are back, and history says this is where it gets serious. The term bond vigilante was coined by economist Ed Yardeni in 1983 to describe a specific and powerful market phenomenon, the tendency of bond market investors, when they lose confidence in a government's fiscal or monetary management, to sell that government's bonds, driving yields higher, and thereby imposing the financial discipline that the government or central bank has failed to impose on itself. The mechanism is straightforward, but its consequences are profound. When bond yields rise, when the market demands more interest in exchange for lending to the government, two things happen simultaneously that neither politicians nor central bankers can easily ignore. First, the government's cost of borrowing rises. At $36 trillion in US debt, every 100 basis point increase in Treasury yields translates into roughly $360 billion in additional annual interest costs as the debt rolls over at higher rates. A 30-year Treasury at 5.2% sustained over time adds hundreds of billions of dollars to an already stressed federal budget, compounding the fiscal dynamics this series documented in its very first video. Second, financial conditions tighten automatically throughout the economy. Mortgage rates, which are priced off Treasury yields, rise, corporate borrowing costs rise. The discount rate applied to future earnings rises, reducing equity valuations. The entire economy feels the tightening that the Federal Reserve declined to impose, not through a single committee decision, but through the distributed judgment of millions of bond market participants simultaneously repricing risk. This is why James Carville's famous observation that if reincarnated he would want to come back as the bond market because it could intimidate everybody resonates so deeply with anyone who understands monetary history. The bond market's power is not arbitrary. It is the accumulated judgment of the most sophisticated institutional investors in the world, expressed in a form that governments and central banks cannot simply talk their way around. Yesterday's bond market verdict was that judgment expressed with unusual clarity. And the historical precedents for what follows such verdicts are the subject of this video. The most historically significant episode of bond vigilantism in modern American history is the late 1970s, the period that culminated in Volcker's Saturday Night Massacre of October 1917, and that represents the most direct precedent for the current situation. Throughout the 1970s, the Burns Fed had allowed inflation to become structurally embedded through monetary accommodation of political pressure, through the repeated discovery of structural reasons why the current inflation was temporary and therefore didn't require aggressive tightening, through the kind of institutional inaction that the 11th video of this series documented in detail. By 1979, CPI inflation was running above 11%. The federal funds rate was elevated but consistently below the inflation rate, meaning real rates were negative. Monetary policy was, despite its nominal tightening, still accommodative in real terms. The bond market's verdict on this situation played out across 1978 and 1970-90 in the form of continuously rising long-term Treasury yields. The 30-year Treasury yield which had been approximately 8% at the beginning of 1978, rose toward 9, then 10, then 11% through 1979 as the bond market progressively lost confidence in the Fed's ability or willingness to bring inflation under control. Each time the Burns and then Miller Fed appeared to be falling further behind the inflation curve. The bond market pushed yields higher, tightening financial conditions in ways that the Fed's official policy was not tightening them. The bond market's verdict was not sufficient by itself to break the inflation dynamic. What it did was create the conditions, the fiscal, financial, and credibility crisis that made Paul Volcker's extreme intervention not just politically possible but practically inevitable. When Carter appointed Volcker in August 1979, the bond market had already delivered its judgment on the existing monetary framework. Volcker's Saturday Night Massacre in October 1979, the brutal rate increases that eventually pushed the federal funds rate to 20%, was the policy response to a bond market verdict that had been building for 2 years. The parallel to the current situation is uncomfortably specific. Walsh held rates yesterday in the face of 4.2% inflation, stalled disinflation acknowledged by the IMF, and oil near $100 per barrel. The bond market responded by pushing the 30-year yield to 5.2%, tightening financial conditions through the market mechanism that the Fed declined to use through its policy mechanism. The question the 1979 precedent forces is whether yesterday's bond market verdict will eventually produce the kind of policy correction that the 1979 verdict eventually produced, and at what cost to the economy and to ordinary people's wealth in the interim. The 1990 future bond market episode is the second major historical precedent for the current situation, and in some ways the more directly instructive one, because it occurred in an environment more similar to the current moment than the late 1970s. In 1993 and early 1994, the US economy was recovering from the 1990 to 1990 recession. The Greenspan Fed had cut rates aggressively during the recession and had been slow to raise them as growth recovered, concerned about the fragility of the recovery and the high debt levels that had accumulated in the private sector. Inflation was not dramatically elevated. It was running around 2.5 to 3%, but the bond market increasingly feared that the Fed's reluctance to tighten was allowing inflationary pressures to build in an accelerating economy. The bond market's verdict was delivered across 1994 in what became known as the Great Bond Massacre, the worst year for bonds in modern American history to that point. The 10-year Treasury yield rose from approximately 5.5% at the start of 1994 to 8% by November, a 220 basis point increase in 11 months. Mortgage rates rose sharply. Bond portfolios lost trillions of dollars in value. Orange County, California filed for bankruptcy after its investment portfolio was destroyed by rising rates. Multiple emerging market currencies came under pressure as rising US yields attracted capital away from developing economies. The 1994 episode is instructive for several reasons beyond its dramatic market impact. First, it occurred when inflation was not dramatically elevated. The bond market was responding to the risk of future inflation rather than confirmed current inflation. In the current situation, with inflation already at 4.2% and oil near $100, the underlying inflationary pressure is significantly more established than it was in 1994. Second, the 1994 episode forced the Greenspan Fed to tighten much more aggressively than it otherwise would have. The Fed raised rates 7 times in 1994, taking the federal funds rate from 3 to 5.5%. The bond market's verdict by tightening financial conditions before the Fed moved ultimately forced the Fed's hand in a direction and at a pace it had been resisting. Third, the mid-1924 episode resolved relatively quickly. Inflation did not become structurally embedded, the Fed's eventual tightening was sufficient to prevent that outcome, and the economy continued growing through the mid-1990s prosperity. This is the more benign historical template. Bond vigilantes force tighter policy, the Fed responds adequately, and the structural inflation dynamic does not fully develop. The question for 2026 is which historical template applies. They might need 90-40 benign resolution, in which bond market pressure forces adequate policy response before structural inflation becomes entrenched, or the 1979 to 1970 severe resolution, in which a decade of inadequate response requires extreme measures to correct. The 30-year Treasury yield at 5.3% is not merely a market data point. It is a number with specific calculable consequences for the American economy and for the fiscal position of the United States government that deserve careful examination. For the federal government, 50% on 30-year treasuries represents a borrowing cost that, if sustained and if applied to the existing debt stock as it rolls over, is dramatically higher than the average interest rate the government was paying on its debt just a few years ago. The US government has been borrowing at an average rate well below current market rates because a large portion of the existing debt stock was issued at the near zero rates that prevailed from 2000 through 20 As that debt matures and is refinanced at current rates, the government's interest costs rise regardless of whether it issues any new debt. The Congressional Budget Office has estimated that every 100 basis point increase in Treasury yields, if sustained, adds approximately $2.5 trillion to projected 10-year federal debt accumulation. With 30-year yields at 5.2%, substantially above the rates at which a significant portion of existing debt was issued, the fiscal mathematics of the U.S. government's position become progressively more challenging with every month that yields remain elevated. For ordinary mortgage holders and potential home buyers, 30-year Treasury yields at 5.2% correspond to 30-year fixed mortgage rates of approximately 7 to 7.5%, levels that have already severely constrained housing affordability as documented in the broader wealth destruction themes of this series. The housing market, which depends on affordable mortgage financing to function, is among the first sectors of the real economy to feel the bond market's verdict in practical terms. For corporate borrowers, 15.2% on the risk-free 30-year Treasury implies corporate borrowing costs substantially above that level, with investment-grade corporate bonds at 6 to 7% and high-yield bonds at 9 to 11%. Companies that took on floating-rate debt during the era of near-zero rates face dramatically higher debt service costs. Companies trying to refinance existing debt at current rates face a significant increase in their interest burden, and companies whose business models depend on cheap capital, growth-stage technology companies, leveraged buyout finance, private equity, face a fundamental repricing of their valuation assumptions. For the holders of long-duration assets, pension funds, insurance companies, sovereign wealth funds, 5.2% on the 30-year represents a continued mark-to-market loss on portfolios that were accumulated when rates were far lower. The duration mismatch that destroyed Silicon Valley Bank in 2023 documented in the 14th video of this series. The bond market's response to yesterday's Fed decision was not merely a reaction to a single data point. It was a cumulative verdict on the trajectory of Federal Reserve policy under Kevin Warsh's leadership, a trajectory that, viewed through the historical framework this series has built, increasingly resembles the Burns template rather than the Volcker template. The evidence for this assessment is specific and accumulating. First, the dot plot abstention. As documented in the 11th video of this series, Warsh declined to submit a dot plot forecast at his first FOMC meeting, an unusual departure from established practice that preserved ambiguity about his inflation-fighting intentions at a moment when clarity was precisely what the bond market required. Second, the rate hold yesterday, with CPI at 4.2%, oil near $100, and the IMF having acknowledged that global disinflation has stalled. Holding rates unchanged represents a judgment that the current level of monetary tightening is adequate for the current inflationary environment. The bond market's verdict, 30-year yields to 5.2%, Dow down 153 points, is a direct refutation of that judgment. The market is saying that current rates are not adequate and that if the Fed will not tighten, the market will. Third, the FOMC statement's language. Reports indicate that Warsh's Post-meeting statement emphasized economic activity expanding at a solid pace and dropped the specific inflation urgency language that bond market participants had been looking for as evidence that the Fed was preparing to move. The omission of that language, the same kind of structural explanatory framing that characterized Burns's statements throughout the 1970s, contributed directly to the market's verdict. The Burns parallel is not a prediction that the current situation will end as the 1970s did. It is an analytical observation that the pattern of institutional behavior finding reasons to hold rates despite elevated inflation, preserving policy optionality at the cost of credibility, is tracking the same template that produced the worst inflation decade in modern American history. The bond market, which has seen this pattern before, is applying the same correction it applied in 1979, forcing the tightening through yields that the central bank declined to impose through its policy rate. Today brings two additional data releases that will either confirm or complicate the bond market's verdict from yesterday: the Q2 GDP first estimate and the June PCE price index, the Federal Reserve's preferred inflation measure. The Q2 GDP estimate matters for the current analysis in a specific way. If Q2 GDP comes in strong above the 2% range, it confirms that the economy is growing despite the elevated interest rates of the past 2 years, which removes the Fed's strongest argument for holding rates, that the economy needs support. A strong Q2 GDP reading that accompanies yesterday's bond market verdict creates the most uncomfortable scenario for worse: an economy that can absorb rate hikes combined with a bond market that is demanding them. If Q2 GDP comes in weak, below n% or negative, it complicates the picture in the direction that Burns always found his reason to stay put: that the economy is too fragile to absorb further tightening, even though inflation remains elevated. This is the stagflation trap documented in the 15th video, the environment where every piece of economic data provides a reason to prioritize one mandated objective over the other, and the result is paralysis. The June PCE price index, released simultaneously today, is the Fed's preferred inflation measure, and it typically runs slightly below CPI. A June PCE reading that confirms the CPI's 4.2% trajectory, or that comes in above expectations, would add urgency to the bond market's verdict. A reading that shows meaningful deceleration would provide wash cover for the hold and potentially stabilize yields. The combination of these two data releases, arriving the morning after the bond market's most decisive single-day verdict in months, creates another convergence comparable in structure to the July 14th convergence examined in the 14th video. The question is whether the data confirms the bond market's judgment or provides a basis for the Fed to argue that its current stance is appropriate. The 1994 bond market episode resolved relatively quickly and without catastrophic economic damage. The reason it resolved relatively quickly is crucial to understand because the resolution mechanism that worked in 1994 is significantly less available in 2026. In 1994, the federal government's debt-to-GDP ratio was approximately 65%. The annual deficit was approximately 3% of GDP. The government's fiscal position, while not perfect, provided significant room to absorb higher interest rates without triggering a fiscal crisis. The additional interest costs from rising yields were manageable relative to the overall budget. In 2026, the federal government's debt-to-GDP ratio exceeds 120%. The annual deficit is running at approximately 6 to 7% of GDP. The government is already spending more on debt interest than on national defense. In this environment, the 30-year Treasury at 5.2% is not a manageable market inconvenience. It is a structural fiscal pressure that compounds the existing debt trajectory in ways that the 1994 fiscal position did not face. This creates a feedback loop that did not operate with the same intensity in 1994. Rising yields increased the government's borrowing costs, worsening the deficit. A worsening deficit requires more bond issuance to fund it. More bond issuance adds supply pressure that pushes yields higher. Higher yields worsen the deficit further. This fiscal feedback loop, where higher yields worsen the fiscal position that is already causing the higher yields, is a structural feature of the current situation that makes the bond market's verdict more consequential than in previous comparable episodes. The historical case that most closely matches this dynamic is not 1994, but the British fiscal crisis of 1976, when rising gilt yields, a deteriorating fiscal position, and a weak currency combined to force the UK government to seek IMF assistance. The British crisis was resolved through a combination of fiscal austerity, IMF conditionality, and a gradual restoration of market confidence, but it required several years of painful adjustment and represented one of the most significant. Placing yesterday's bond market verdict within the framework this series has built across 20 videos produces the most direct and specific conclusion the series has yet reached. The first video of this series opened with the observation that the bond market was breaking, that long-term treasury yields were rising in ways that historical precedent identified as structurally significant rather than cyclically temporary. That observation was made in the context of a channel that just beginning to build its analytical framework. 20 videos later, the bond market has delivered its clearest verdict yet, a single-day move that pushed the 30-year Treasury to 5.2% in direct response to a Fed decision that the market judged as inadequate to the inflationary environment. The structural mechanisms documented across 19 previous videos, the debt burden, the petrodollar vulnerability, the stalled disinflation, the institutional confidence erosion have converged in a single market day into a number 5.3%. That number is not the end of the story. The bond market's verdicts in 1979 and 1994 were not endpoints, they were inflection points that forced policy responses and economic adjustments that played out over months and years. Yesterday's verdict will similarly force responses from Warsh's Fed, from the Treasury, from the administration, from the political system trying to manage the fiscal consequences of yields at these levels. The historical framework suggests those responses would be the most consequential policy decisions of the current period. The Burns template leads toward continued inadequate response, further yield increases, and eventually the kind of extreme intervention that produces severe near-term damage. The Volcker template leads toward decisive tightening that accepts short-term economic pain in exchange for breaking the inflationary dynamic before it becomes fully entrenched. The bond market has delivered its judgment. The question is whether the policy response will match it. Yesterday, the Federal Reserve stayed on the sidelines. The bond market did not. 5.2% on the 30-year Treasury, 1,053 points off the Dow. The Nasdaq in correction territory. And today, Q2 GDP and PCE data that will either confirm the bond market's verdict or give Warsh's Fed a data-based argument for its inaction. This series opened 20 videos ago with a bond market that was breaking. It has documented across every subsequent video the mechanisms that were driving that break, the debt, the gold, the petrodollar, the middle class wealth destruction, the sanctions, the internal fragmentation, the reserve currency timeline, the asset class survival record, the ceasefires, the Fed chair transitions, the treasury sales, the alliances, the convergences, the stagflation, the bypass, the IMF admission, the banker who walked away, the dollar confession in gold's price. Yesterday, those 20 mechanisms expressed themselves in a single number, 5.2%. History knows what comes next when the bond market reaches this kind of verdict against a central bank that has been running behind the inflation curve. It is not comfortable, it is not quick, and it does not resolve itself without the kind of policy decisions that, in every previous iteration of this pattern,